Hello, teachers and students. Todd Bubba Horowitz here once again from highschoolinvesting.com. And of course, looking at last week's market activity, we see a market that continues to go higher, defying all of the odds that we can imagine, which is why we believe in technical analysis versus fundamental analysis. Because again, fundamentally, what we are seeing here is company after company beat or miss already reduced or expected earnings. And one of the things we learn while we're trading is how to understand market expectations versus reality, because the two are not necessarily the same thing. Market expectations are what the street or traders or investors are pricing into a stock, and the results are only based on what was expected by the street. They are not results that were expected by the company, but more by the street, because the street builds in expectations of what they expect. So when we look at what's going on as we open up earnings season for the third quarter going into the fourth quarter, we now see company after company just barely beating what's already been lowered expectations, or not even able to meet the expectations that they're bringing out. So when we look at the overall big picture, here's what you want to understand. The market's built in expectations. If they beat expectations, you will typically see some sort of a rally. If they miss, you'll see a sell-off. But at the end, it comes back to where are we in this overall chart pattern? Where is the market in relationship? And what are we going to do from there? And that's where you want to be able to find good solid base levels to either buy or good solid resistance levels to sell. So when you look overall through a market, and if you take a look at the Dow chart, the Dow Jones Industrial Average, you will see the market has just recently broke out from a solid consolidation pattern, indicating that the market is trying to go higher. And if you talk about what fundamentally is driving the market higher, there is nothing fundamentally driving the market higher right now. What's driving the market is, first of all, the Federal Reserve, the low interest rate policy, and what is now known as the chase for yield. As you get more into the class, you will see that we will talk about yield and how you get that, whether you put the money in a bank or wherever, because yield is to be determined on your portfolio. You're looking, when you invest in anything, you're looking to get a return, which is really called yield, on the money that you are investing. So as we see the markets, there is no place right now. You can't go into a bank to put money in the bank because there's no return. Bonds, which is another product you haven't learned about yet, it has no return. So the only game in town right now is the equity market. So when we look at it, we go, okay, that's why there's being more money flowing in. However, fundamentally, the markets and the economy is in very bad shape. But of course, the stock market is also near record highs. So think about that the next time you look at a chart and you understand why I'm saying to you that it's the technical analysis that helps us buy a better company that has good fundamentals. But we want to wait for the technical aspect before we jump in the markets, because again, all the news that's out there is just news. It's really just noise, and it always comes back to what we call the footprint that the markets leave, because like anything else, the market leaves a footprint in the charts, giving you the best idea or for general direction of where the market is going. And that will do it for our today's little traders, investors, how we work the markets. This is Todd Bubba Horowitz coming to you from the CME Group in Chicago, right on the floor. We'll see you next time. Thank you so much.